This is the S&P 500 market update for the week of February 2nd, 2026. The market just hit new all-time highs, but the big question remains, is this the final sprint toward our 7,321 target, or are the cycles whispering a warning of a major peak? Today, we're peeling back the layers of the Hurst Nominal Model, from the 18-month macro view down to the 40-day timing ripples, to map out exactly where the market is headed. Let's dive into the charts and see what the math is telling us. Let's start with the big picture, the 18-month cycle. With last week's new all-time high, the S&P 500 seems determined to reach that 7,321 upside target. Currently, the market is trading well above its cycle line, and more importantly, its cycle trend line, or VTL. Looking at the long-term data, there is absolutely no sign of weakness yet. However, we must keep our eyes on the 18-month low expected later this year, between September and October. For now, focus on the cycle line and the trend line. A decisive cross below these levels will be our confirmation that the 18-month peak is finally in. For those wanting a deeper dive into the 54-month macro cycles, be sure to check out my previous videos where I break those down in detail. Moving into the 40-week cycle, we have two distinct scenarios to navigate. The first suggests the 40-week low occurred back in November 2025. The second suggests that low is actually happening right now in the final week of January. To stay objective, let's work with the November 21st, 2025 low as our primary scenario. Interestingly, despite the new highs, the S&P 500 crossed slightly below the cycle trend line, or VTL, during the week of January 20th, and has remained there. To draw the VTL, I start from the April 2025 low to the November low. If we see a sharp move lower from here, it would be a major bearish signal, suggesting that the current high is indeed the 18-month peak. In that case, we would likely miss the 7,321 target, leading to a deeper decline toward the cycle line. Regardless of which scenario wins out, the next major low is synchronized for August to October 2026. The 20-week cycle. Can the 20-week cycle help us clear up the uncertainty? Following the Hurst Nominal Model, it makes perfect sense to place our first 20-week low in late July 2025. That cycle lasted 16 weeks, roughly 112 days, which is a bit shorter than the 19.4-week average, but confirmed by a very prominent bearish candle. If we project another 16-week cycle forward, it lands us exactly on the week of November 21st, 2025. Thanks to the principle of synchronicity, this strongly reinforces the idea that November 21st was our 40-week low. While having absolute precision on this date isn't primordial for our immediate trading signals, it gives us much higher confidence in our roadmap. Always keep the alternative scenario in mind, but the weight of the evidence points to November. Now, let's look at the 80-day cycle. Regardless of the larger scenario, November 21st was definitely an 80-day low. Following a 61-day run, our next 80-day trough formed right on schedule on January 20th. The fact that the S&P 500 found support exactly on its cycle line on January 20th is a classic Hurst signal often seen after major lows. This further validates our November 40-week bottom. We now have a fresh cycle trend line to help us identify the next 80-day and 20-week peaks. To draw this 80-day cycle trend line, I start from the November 2025 low up to the January 20th low. As we head toward the next 80-day, low will be looking for a cross below the cycle line to provide downside targets, with the best time window for that low falling around March 28th. Finally, the 40-day cycle. Since the 80-day low landed on January 20th, according to the Hurst principle of synchronicity, that date also marked our 40-day trough. The next 40-day low is expected around February 23rd. This will be the first real test of how much bullishness is actually left in this market. It is critical to see the market find support and rebound off its cycle line here. Any sharp break below this line would be the first canary in the coal mine, an early sign of weakness that could signal an early formation of that major 18-month peak. We also need to monitor where the S&P 500 will form its next 40-day peak. Technically, the cycle's peak is expected right at the top of the cycle, in this case, on February 6th, marked by the yellow dashed vertical line. However, Hurst's peak translation principle applies here. This principle helps identify the magnitude of the next correction based on where prices peak relative to the cycle's peak. According to this rule, if prices peak before the cycle's peak, on the left side, This is a bearish sign, and we can expect a sharp correction. Conversely, if prices peak after the cycle's peak, we can expect a moderate correction. The size of the correction is proportional to the size of the cycle. If, during the next 40-day peak formation, prices peak before February 6th and cross below the cycle line, this will be the first sign of weakness. In conclusion, while the price action is hitting new highs, our cycle analysis is reaching a point of high tension. The next few weeks will tell us if the 7,321 target is a reality or if the 18-month peak is already behind us. If you found this breakdown helpful, please hit that like button and subscribe to stay updated on these critical turns. I'll see you in the next update, and happy trading.